Welcome to The Long and Short, an audio blog production by Eurozone SLJ Capital that takes a look at the macroeconomic themes of the past week and has been recorded for professional investors. This is an audio version of a LinkedIn newsletter written by Neil Staines, published on the 31st of January 2025. Last week, we discussed the US presidential inauguration, set against the gathering of the global elite at the World Economic Forum in Davos. We highlighted our observation that one glaring difference between the US and its European economic counterparts at the current economic juncture is the pace of change. Policy change is clearly moving at pace in the US, while the glacial, philosophical debate at the Eurozone level, where change requires unanimity across disparate member states with differing economic priorities. This divergence between Europe and the US is increasingly a topic of conversation, not just about the Eurozone, but within it. Recently, Macron stated that Europe needs a massive regulatory pause, starting with ESG rules as the bloc struggles to revive its competitiveness against a backdrop of sweeping regulation across the Atlantic. This sentiment was echoed by LVMH CEO Bernard Arnault, who talked of a wind of optimism prevailing in the US compared to the cold shower of European regulation. This week, we will take a look at the US and Europe from a monetary policy perspective. Fed up? Against the backdrop of a whirlwind start to the new presidential administration in the US and the attention that President Trump brings to the White House, not to mention the attention that the DeepSeek AI release brought to the global equity markets, Chair Powell and the Federal Reserve Board have gotten little attention of late. However, the FOMC meeting this week addressed the balance, for a while at least. Going into the meeting, there was no expectation of any policy action after the December meeting cut rates by 25 basis points to a target of 4.25% to 4.50%, and outlined more balanced risks to the policy objective that clearly implied a slowing of the pace of rate cuts. Indeed, the updated dot plot projections being cut to a median expectation of just 2 rate cuts in 2025 emphasized the slowing pace of policy easing further. Statement. After minor changes to the statement, removing the sentence, inflation has made progress toward the committee's 2% objective, and maintaining the reference to labour markets having stabilized, markets viewed the statement as a modestly hawkish iteration. However, the press conference narrative from Chair Powell was significantly more balanced. We have some thoughts. Firstly, Powell made it clear that removing the inflation progress sentence in the statement was a language cleanup and had no direct or indirect policy implications. Secondly, while the dovish bias appeared to have been withdrawn from the statement, Powell was clear to re-emphasize the asymmetric dovish reaction function through the suggestion that policy rates will be held at the current level of restriction if activity is stronger than expected, but could be cut faster if activity proves weaker. On the absolute level of restrictiveness of the current policy stance, Powell stated that, "I would say that we are meaningfully above it, the neutral rate." Key factors. The key point was really the uncertainty around the 4 variables related to the incoming administration and their policy implementation. Tariffs and immigration policy on the inflationary side, and regulatory and fiscal consolidation on the disinflationary side in terms of both sequencing and magnitude. The implications of the fiscal and economic policies of the Trump administration are hugely important for the near-term inflation trajectory, for the labour market, supply and demand, for the deficit, and thus for the term premium of the yield curve, for consumer sentiment, and thus for monetary policy. The key variables in determining the evolution of Fed policy through 2025, and the key reason that the Fed are currently pausing. Following the announcement from the Bank of Canada, as they cut rates to 3% and removed their easing bias, that they would end their QT program, Powell was asked a question on QT that drew a very careful, awkward response. He said that currently, reserves are abundant, and thus, the Fed will continue to reduce their asset holdings, but that the Fed is closely following a range of indicators to indicate the level of abundance of reserves with respect to ending QT. The Fed, and indeed all global central banks, have been very clear over recent years to give one message only at a policy meeting, especially when there is a change in policy. It is possible that there will be an announcement in the US on the QT program over coming months, potentially as a pseudo-policy tool in the event of curve steepening in response to fiscal policy. The ECB cut rates 25 basis points to 2.75% as expected this week, and maintained the underlying narrative that the direction of travel on rates remains clear. However, while the direction remains clear for now, there were hints at a more encouraging, if nascent, growth recovery that increases the uncertainty about the terminal rate from the ECB. Indeed, Lagarde noted that the Governing Council would release an updated estimate of the neutral rate, R star, although we would argue a near-term R star as opposed to the theoretical long-term R star on the 7th of February. It is also worth noting that this is expected to be a range, and Lagarde was clear to point out that it was unlikely to have a mechanical impact on monetary policy over the near term. In the press conference, Lagarde gave a number of indicators that contributed to what we saw as a more positive ECB inference on the growth trajectory. A strong labour market with rising real wages, resilient corporate profits, more affordable credit, and the expectation of a rising contribution of net exports as the global economy recovers. Indeed, consistent with this, the ECB released a comment later in the day, post-ECB press conference, that the ECB may drop restrictive label on the rate stance as soon as March. This likely brings the focus back to terminal rate expectations in Europe. The long and short of it. The global macro backdrop has many moving parts at the moment, from the volatility in the chips and semis space as a function of computing and inference breakthroughs in the AI space, to the growth and inflation differentials in the US and Europe. However, at the current juncture, the economic and fiscal policies of the new US administration are likely the most consequential to almost all moving parts within the global macroeconomy. The Fed has indicated that they are effectively on pause until they have greater clarity on the magnitude and sequencing of the four components of Trump's policies. For us, it is not just the Fed that is likely to stop for a minute. This newsletter is issued by Eurozone SLJ Capital Limited, ESLJ, a private limited company registered in England, company number 09775525, having its registered office at 90 Queen Street, London EC4N1SA, United Kingdom. ESLJ is authorised and regulated by the Financial Conduct Authority, FRN 736926. This newsletter is a marketing communication intended solely for professional investors in jurisdictions where the public offering of products or services is authorized and is provided only for information purposes. It has not been prepared in accordance with legal and regulatory requirements designed to promote the independence of investment research, and is not subject to any prohibition on dealing ahead of the dissemination of investment research. It does not constitute research on investment matters and should not be construed as containing any recommendation, advice or suggestion, implicit or explicit, with respect to any investment strategy or financial instruments. The issuers of any financial instruments or a solicitation, offer, or financial promotion relating to any securities or investments. ESLJ and its affiliates do not assume any liability whatsoever for the contents of this newsletter, and do not make any representation or warranty as to the accuracy or completeness of any information contained in this communication. Views are accurate as of the time of publication. Opinions expressed by individuals are their own and do not necessarily reflect those of ESLJ or any of its affiliates. The value of any investment may change, and an investor may not get back the original amount invested. Past performance is not an indicator of future performance. This communication may not be reproduced, redistributed, or copied in whole or in part for any purpose. It may not be distributed in any jurisdiction where its distribution may be restricted by law, and persons into whose possession this communication comes should inform themselves about and observe any such restrictions. ESLJ is a company of Intesa Sanpaolo S.p.A.,